Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, a guy we don't get that often, but we're always glad to get him, Eric Sprott. Eric Sprott, thank you for joining us today on USA Watchdog.
Greg, always happy to be with you. Very happy about the service you have to your viewers, and you're one of the people who tells the truth down there, and we really appreciate it, and I really appreciate all the interviews you do of other people.
Well, thank you very much. I know you're coming to us from Toronto today. You are, of course, president and CEO of Sprott Asset Management. You have $8 billion under management. And I just want to start out with the price of silver. I mean, it dipped below $22 an ounce. I think today or last week it got back over 22. What kind of pushback are you getting from people that are saying, "Wow, this isn't going straight up like a rocket"? Well, what are you saying to people?
Yeah. Well, it's interesting. I mean, you can appreciate that when you go from 50 to 22 and you've been a silver bull, not that I was a silver bull. I was a silver bull back in 2000, by the way, when it was also $5. You get a lot of criticism because people think you've lost your marbles, particularly with the stock market going up, which I'm not a great believer in the stock market. I think, well, you're at a tomb and everything. And I sort of go back to our history. I mean, we called the NASDAQ top. We called the investments in gold back in 2000. We've invested a lot of money in gold. We blew the market away in 01, 02 when the market was tanking. And it's always been my view that our views will prove to be correct. We analyze the silver and gold markets intensely, and we think both of them will certainly hit new highs, and that will be either this year or early next year.
Oh, you think silver's going to hit new high and gold's going to hit new high in 2013 or early 2014?
Absolutely. Based on all the information we see, and I'm happy to discuss that.
Well, why do you think they're going to hit new highs? I know one thing, the U.S. Mint is making gold and silver eagles as fast as they can buy blanks and pound them into coins. So, I mean, that's unbelievable. You have a falling price, and then you have rising, huge, record-breaking physical demand. It's a giant disconnect in the market, is it not?
Yes. And all of my analysis is based on the physical market. And we did a paper back in, I think it was December 12, when we said, there are net new buyers over the last decade per year of something close to 2,300 tons of gold in a 4,000-ton market that's been flat in the supply for 11 years. And how did all these new entrants come into this physical gold market? And I'm referring to central banks who used to be sellers, now they're buyers. There were no ETFs in 2000, now they buy 200 and 300 tons a year. Of course, we get the Chinese data, the Indian data, the Mint data, and it's all gone exponential since 2000. And yet supply's never gone up. So you have to assume that somebody is supplying this market, which I've always assumed to be the Western central banks. And they've held the price down. And I think for various obvious reasons. And I go back to what Chairman Volcker said post 1980 when he became the Fed chairman. He said the mistake we made in the 70s was not getting control of the gold price. And as you know, it went from 35 to 850. Inflation broke out. Interest rates went up into the teens. And I think that central banks, one, they know that the zero interest rate policy and they know that printing money is financial insanity. They know it. They don't have a choice. But that's the choice they've made because they want to try to keep it together. But I think ultimately they're going to be unsuccessful, and ultimately people will figure it out that they should own gold and silver.
Well, I want to bring up, the price of gold in this realm because everybody from the little guy on the street, it seems like, or at least a small investor, to China and India and Russia and hedge funds. George Soros just exited out of GLD, and he took gold, not cash, if that tells you anything. And so, but I want to bring into the risk premium. A lot of people on my site will come on and they'll try to make these trading comments. Well, if you bought at $1,700 gold, you feel really bad right now. And I wrote my guy back just the other day and said, well, if you bought at 300 or 400 or 500 or 600 or 700 or 800, yeah, you understand what I mean. Yeah. You know what? You can pick any point in time. Yeah. And so, and plus, people don't realize that in the in the 70s that you brought up, went to 850. Well, it went down from about 200. In 74, down to about 103, 9 months later in 75. But it wasn't until mid-78 that they went back up to 200 again.
Right.
I mean, it was a 3.5 year slog to get back up to where it was in 74. 78 is basically about 4.5 years later, roughly. Are you seeing that kind of action this year? We've had like about a 2.5 year or so, the long
Sure.
downward trend for gold and silver.
Well, it's been a long run, but I've been investing for too many years now, and I've had many, many times when we are out of favor with the market, or the market's out of favor with us, whatever. And typically, the market always comes back to what we believe. For example, if you are a bear in the NASDAQ in 99 or 98, these values are ridiculous. You look like the biggest fool of all time. Of course, along comes 2000, it corrects by 75%, and you don't look that stupid after a while.
Yeah.
And it's hard to tell when the last guy making a mistake will make that mistake. So, for example, as you know, we see these hedge funds shorting the dickens out of gold futures, and now all the commercials have covered and basically gone long gold. And I mean, we're in a perfect setup here where guys who really don't believe in gold anyway are taking the short side of the argument. Whereas I think the people who've been buying gold for a long time, we're pretty comfortable with the fact that it should go up. It's gone up every year. Will be very surprised it's not up by the end of this year on the year. And I think those guys who've gone short, in fact, record amounts, are going to have a very big losing hand. So we just got to wait for things to turn around. We talk about all this tapering, and of course, yesterday we read, well, maybe there won't be tapering. And I think we all know there can't be tapering, and the market is always trying to condition itself to not like gold, but I think there's enough of us that understand what's going on to believe that the price of gold will be going higher.
If they shut off the money printing, Mr. Sprott, don't you think the market implodes? You ask any of these traders, oh, well, there'll be a correction. Oh, no, there won't. No, it'll be an implosion. We'll be back to 666. Will we not?
Yes. Well, of course, Greg, I mean, if interest rates went up, and they've already gone up a little, right? They've gone up enough now that it's going to affect things. It will affect new home sales. It'll affect car sales where interest rates are a very significant factor. And God forbid the rates went up to 5% on the 10-year, because then the government deficit would explode. The housing would crash. Of course, lowering interest rates is the one thing that's kind of held things together. When I look at the economy, which I characterize as very weak, there are two noticeable differences that the housing has recovered. Now, mind you, it hasn't recovered anywhere near where it was, but it has recovered, and as has car sales. But they've both been induced by this zero interest rate policy. So
right.
Take away the zero interest rate policy, and those numbers would come down very, very quickly.
And also subprime loans for both entities. Not quite so much as the houses for cars. Breathe on this mirror, and you can get a car loan. You can get a brand new car.
Yeah.
I want to talk to you about another big factor in what people should be thinking. Because everybody, if you asked a common guy on the street about 2008, oh, that's over. Everything's fixed. Listen, nothing's fixed. They didn't fix anything. They brought in phony accounting in 2009. They printed tons of money in QE1, QE2, Twist, and now Infinity in terms of money printing. And now they're talking about, and you wrote an article about this, and I want you to address this because this is some real fear factor here. And, when Cyprus first broke, oh, it's just a one-off thing. Well, now it's a template. And you wrote about this in a recent article about bail-ins, and they're coming to Europe, and I find it hard to believe they wouldn't come to Canada and they wouldn't come to the U.S. Tell me about that.
Well, the shocking thing to me is that obviously most governments now have put in legislation or rules in their banking system for bail-ins. And of course, we had the bail-in in Cyprus, which really means that creditors, the depositors who are considered creditors, bore part of the loss, which was a very, very unusual situation. When we first had the banking crisis, the governments would bail out the banks. Then when the governments realized, well, it's too big for us, and they have the central banks bail out the banks. Then the central banks realized it's too big for them. So now we have this new template where a bail-in, or a too big to bail institution, the depositors who are creditors and unsecured creditors, I might add, will be thrown into the mix. And you would find it interesting to know that even in the March budget in Canada, we put in legislation in Canada to allow bail-ins. And the fact that all countries are doing it together means there has been a discussion on this. They've all agreed. This is what's going to happen here. And, we've had Japan just do it. We had the UK, the ECB, New Zealand. It's been universally accepted. And even the BIS came out and said, this is a simple solution to the banking problem, which I could hardly believe I had to hear that word simple. It's simple for someone to solve the banking problem. It's not so simple for the depositor. And one of my theses has been when it becomes apparent to people that having deposits in a bank is a risk, that will have a dramatic impact on precious metals. That is the ultimate win for precious metals, and God knows what the price would be if you turn some of those depositors into people who need to own gold and silver.
Well, in the U.S., and I just looked this up a few months ago, and I called the FDIC. I just made sure I went through it line by line. They were so happy. They went from they're up to $33 billion now in the Deposit Insurance Fund. It's called DIF. $33 billion. They have $10.8 trillion insured by $33 billion. That's like having $33 insuring $10,800 worth of risk. No insurance commissioner in any country, in any state, would allow anybody to write a policy. We have a line of credit, $100 billion. So you have $1.33, $133, excuse me, to insure $10.8 trillion. The money's not there. Is it in America? Do they have $10.8 trillion where everybody can run to the bank and get their money?
Right. It's a pure fantasy. The money's not there. Somehow people believe it. I mean, it's almost like the lemmings, going over the cliff. People seem to think that the FDIC can stand behind them. They cannot. And the FDIC has many contingent liabilities. As you know, whenever a bank goes down, the FDIC has to support the acquiring bank to buy the assets. God knows how many banks are still on the list that are going to cost the FDIC huge amounts of money already. So even if they have $33 billion in cash, some of that's going to be committed to those future failures. And as Greg, you well point out, I mean, 33 versus 10 trillion, I mean, it's effectively has zero for all intents and purposes.
Well, I mean, everybody was talking about, we'll just get the people who are uninsured depositors, and we'll get the shareholders, and we'll make a bad bank, and we'll do all this stuff. And everybody thinks, I have under the $250,000 limit, and my wife has under the $250,000 limit, and it's not going to affect me. Really? That's what they did over in Cyprus, where I was under the 100,000 euro limit. I'd like to have 50,000 euros. No, you can have $300. Yeah. People don't understand that even if you're under the limit, I mean, isn't this right? That you're not going to be able to have full access to the insured deposit, are you?
Yeah, that's the important point, that yes, it's theoretically in the bank, but you couldn't access it. And Greg, one of the interesting things in my mind about the Cyprus bail-in, if you put Cyprus bail-in into Google and you try to read about it, it is not in the mainstream media. There was no reporting of it. The only reporting I saw was in the Chinese media and in blogs, sites like yours and others. But for all intents and purposes, it's been restricted because they don't want people to think that the next bail-in is coming. But you and I both know that there have to be bank runs going on in Europe, in various countries, because of the recessions, almost depressions going on. They know what happened in Cyprus. You could just imagine that, you're the CFO of IBM or Microsoft or GE. You have operations in Cyprus. You saw what happened to bank deposits. Yours were over 100,000. You lost money if you had it there. Wouldn't you go to the next guy on the list, the next weakest guy, and take your money out? You know that must be happening. And we've seen all sorts of data out of the U.S. Federal Reserve, how I think they've lent foreign subsidiaries in the States something like $1 trillion already in the last 12 months. And I think that's going to pay off these deposits that are fleeing the banks. And I think that's why we're setting up for the bail-in here. Why is there all this rhetoric and talk about a bail-in all of a sudden? Because that's the expected solution.
And you're talking $1 trillion that the Fed has over there in their euro dollar swaps. That's what you're talking about.
Yeah.
$85 billion a month. There's a shade more than $1 trillion over here, and nothing's fixed. That's the frightening thing. We spent $2 trillion in the last 12 months, basically, in two continents, and you don't have a solution.
Right. We effectively have very, very little growth. I mean, I could go on and on about how the growth is being supported by the U.S. government. I focus on the U.S., whether it's through food stamps or student loans or, subsidized housing, whatever. I mean, there's been so many examples of people getting money who shouldn't be getting money and people buying products who shouldn't be buying products. And you take a little bit of that away and you have no growth in the economy.
Well, one last thing I wanted to bring up is about all this high demand. It's not just at the U.S. Mint. There's also high demand at the vaults at J.P. Morgan for redemptions. And, one day, Zero had last week had that J.P. Morgan lost, 28% of its gold?
Yes.
And in one day?
Yeah. And by the way, Greg, I should mention that there's another website that I use called HarveyOrgan.com, and he analyzes pretty well every day what goes in and out and what's being requested in terms of redemptions. And he's come to the conclusion that J.P. Morgan really has a negative balance of gold because all these claims have been made on their gold that they haven't yet delivered. And we all know collectively that the COMEX gold's gone from over 11 million ounces to something like 7.7 million recently. And it's my thesis that the mid-April crash was premeditated. It was because it became quite obvious that there was a shortage of physical gold, which I've always believed, and that's why I've written these articles. Look at all the demand here. And I think they tried this kind of raid to cause people to sell gold. You know what? It totally backfired. All of a sudden, the demand doubled and tripled and went crazy. And now we're sort of frittering around here while the commercials are covering their shorts and the hedges are getting long because they're falling for the story. But the physical demand is unbelievable. I think we'll see things bounce up very, very quickly here. We have it's a seasonally strong time, right? That normally starts at this time of year. It's like back in the middle of June. So I think we got much, much, much better days ahead of us.
Well, are COMEX and LBMA going to sell the last bar of their gold? Or at some point do they say, force majeure, we'll pay you in cash, sorry? And at what point does that happen?
Well, my biggest fear is that maybe one of the reasons they're taking the price down is they know they're going to fail. And they want to write a small check rather than a big check. If they can just close it down one day and gold's at $1,300, everybody gets a check and nobody gets their gold and, wipe our hands and get out of Dodge.
Do you think that's going to happen?
Well, I fear there's a shortage of physical gold. So somebody's going to fail here, okay? All the data I look at says that the Western central banks that, in my mind, for sure have been selling gold are running on fumes now. And that's why this takedown happened. So it's very close in hand.
Eric Sprott of Sprott Asset Management, thank you very much for joining us today on USAWatchdog.com.
Thank you. Look forward to all your interviews.
Okay.